Spain in 2006 was experiencing a period of economic growth. Over the past 6 years, the country's per capita production had doubled, fueling optimism about its future. German economists predicted that within 5 years, Spain would surpass Germany in income levels, establishing itself as a major European power. Certain regions had nearly eradicated unemployment, and the government had created favorable conditions for employment and enterprise. The nation was confident that this upward trajectory would continue indefinitely. Foreign investors found fertile ground in Spain, facilitated by the eurozone, which made it easier to invest through real estate purchases. Many bought seaside homes or apartments in large cities, seeking both economic growth and leisure under the sun. Real estate agents became a common sight on the streets, and construction companies thrived. Even workers like plumbers could afford luxury cars, as the economy seemed to operate on a self-sustaining cycle of investment and expansion. People poured money into property, which in turn attracted more investors, fueling further growth and making Spain increasingly appealing to outsiders. However, this prosperity was illusory, built on a fragile foundation of mounting debt. When the global financial crisis and the eurozone downturn struck, the debt pyramid collapsed. Nearly 2 decades later, Spain's economy remained sluggish, with unemployment still high, particularly among young people, and growth stagnant. Paradoxically, despite these setbacks, the real estate market remained prohibitively expensive for most citizens. Spain thus became a cautionary tale of how excessive borrowing can undermine even the most promising plans. Many experts argue that, at that time, Spain's economic vulnerabilities were less severe than those faced by some larger nations today. This raises questions about whether the world has truly learned from Spain's crisis. What factors drove Spain's rapid growth? Why did it collapse so dramatically, and why has recovery been so slow? Are other countries now at risk of experiencing similar crises? Spain's economic history has been marked by cycles of boom and bust. The country had endured many upheavals, from colonial empires to post-World War II reconstruction. To understand what happened in the early 2000s, it's essential to look back to the 1990s when the nation's ascent began. During that decade, Spain grappled with persistently high unemployment that refused to decline for years. It joined the European Economic Community in Одна тысяча девятьсот восемьдесят шесть, at a time when its economy lagged behind, with a gross domestic product per capita at only 73% of the EU average. In the 1990s, after a global recession, Spanish authorities managed to curb inflation and improve the national budget, which helped reduce unemployment. By the mid-1990s, economic conditions started to improve. In Одна тысяча девятьсот девяносто девять, Spain became one of the first countries to adopt the euro. This decision brought both advantages and disadvantages. While retaining its own currency allowed countries to control monetary policy, such as devaluing currency or setting interest rates, Spain, after adopting the euro, lost this independence, leaving its economy more exposed to external shocks. Spain's economic trajectory became increasingly dependent on the broader policies of the eurozone, which significantly limited its ability to independently steer its economy, especially during turbulent times. As a result, the Spanish financial crisis can be viewed as a consequence of losing control over vital economic tools. Before the crisis, Spain experienced a remarkable economic boom, a phenomenon largely driven by its integration into the euro area. The introduction of the single currency simplified cross-border trade, making it easier for businesses and consumers to compare prices and negotiate better deals. Crucially, the euro proved far more stable than Spain's previous currency, the peseta, which had suffered from volatility. This stability, reinforced by the widespread adoption of the euro across many countries, enhanced Spain's position in international trade and made borrowing significantly more accessible. Cheap credit fueled this growth, acting as a catalyst for economic expansion. What initially appeared as a boon, however, harbored darker implications. Many saw Spain transforming into a potential new powerhouse within the eurozone, a view that gained momentum around 1998, the year the euro was introduced. At that time, the country faced rising immigration, which the government viewed as an opportunity for development. The increasing population created a surge in demand for housing, prompting a rapid expansion of the construction sector. This construction boom was a strategic move by the government, as it generated employment, crucial for a nation long plagued by high unemployment. During this period, ordinary workers who previously could barely afford modest cars began purchasing luxury vehicles, driven by the booming labor market. The primary driver of this economic surge was the availability of low-interest loans, facilitated by the euro's stability, which minimized currency risk. Spanish banks eagerly extended credit, leveraging the favorable conditions. Real estate became the main investment vehicle, with construction accelerating at an extraordinary pace. The government also played a role by offering substantial tax incentives related to property, attracting both domestic and foreign investors. Unlike many other countries, Spain exempted rental income from taxation, allowed deductions for mortgage interest payments, and permitted the subtraction of principal loan repayments from taxable income. These measures made Spain especially attractive to investors, further fueling borrowing and construction. Yet, amid this apparent prosperity, questions arose. Why did Spain's central authorities fail to recognize the impending crisis? Why did international investors overlook the mounting risks associated with ballooning debt levels? Looking back, it's clear that many economic indicators already pointed toward trouble, but at the time, few paid heed to these warning signs. Much like the case of Bernie Madoff, once hailed as a financial genius and later exposed as a fraud, many individuals should have exercised greater caution. A key factor that concealed the true state of affairs was the unique structure of Spain's economy and its fiscal decentralization. Spain stands out as one of the few nations where the central government plays a minimal role in borrowing decisions. Instead, most financial responsibilities are managed by autonomous regions, which oversee their own budgets. The country comprises 17 such regions, including the Canary and Balearic Islands, along with 2 autonomous cities in Africa. These regions independently collected taxes and financed healthcare and education, significantly masking the country's overall debt levels. During this period, Spain had approximately 45 regional savings banks, known as cajas, which heavily invested in real estate. This reporting gap allowed Spain to display positive economic indicators, even as the underlying situation was far more precarious. When Spain joined the European Union, many legal barriers for foreign investment were lifted, leading to an influx of funds from countries like Germany, the United Kingdom, and France. This fueled a construction boom that created numerous new jobs. At its peak, Spain alone generated over half of all new employment within the EU. Construction became the engine of economic growth, with housing prices soaring by 70% in just 5 years, from 2003 to 2008. Yet, this growth was built on fragile foundations. Although Spain anticipated potential risks and established a reserve fund of 35 billion euros to cover bad loans, this amount proved insufficient to withstand the impending crisis. The country ultimately could not avoid collapse. So, what was the primary cause of this failure? The rapid expansion of housing construction, driven by the belief that demand would continue indefinitely, played a significant role. Spain drastically underestimated the actual need for new homes. By 2006, over 800,000 houses had been built, housing around 200,000 families. During this construction frenzy, some market players resorted to outright deception rather than attempting to influence laws in their favor. Researchers Jose Rea and Jose Garcia Maltosa analyzed the mortgage system to understand housing prices better. They focused on the loan-to-value (LTV) ratio, which compares the size of the mortgage to the property's value. At first glance, this seemed straightforward. The Bank of Spain considered an LTV below 80% to be relatively safe, since 20% of the property's value was already paid. However, as the LTV approached 100%, the risk of default increased sharply. Rea and Maltosa made a startling discovery. The closer the LTV got to 100%, the higher the likelihood that borrowers would fail to repay their loans. This insight revealed the inherent danger in the mortgage system that had fueled Spain's housing bubble. Banks found a way to lend money without strictly following the rules, doing so with remarkable cunning. When bank employees noticed that the loan-to-value ratio was nearing 100%, they would simply contact appraisal companies and request a lower property valuation. This automatically reduced the LTV, allowing the loan to be approved. According to researchers, appraisal firms often inflated property prices intentionally, enabling banks to approve mortgages that otherwise would have been rejected. Buyers could purchase homes at these inflated values, while banks technically remained within legal boundaries. This practice represented one of the most significant risks that Spanish banks took, often without fully understanding or ignoring the potential fallout. Over time, properties were grossly overvalued, which ultimately led to a collapse when homeowners could no longer meet their mortgage obligations. The artificially inflated real estate prices, maintained by appraisers and banks alike, appeared to be a lucrative deal for many Spaniards. But the bubble was destined to burst. When the market crashed, the total debt in Spain's real estate sector approached nearly half of the country's gross domestic product. Thousands of families found themselves unable to repay their loans, and property values plummeted sharply. Banks faced losses because homes sold for less than their purchase prices, rendering their loans unrecoverable. Previously endless credit lines suddenly dried up. Construction firms, thriving on speculation, were left with enormous debts. The 35 billion euros set aside as a crisis reserve proved insufficient, a mere drop in the ocean that failed to mitigate the damage. This scenario, though seemingly irrational, is echoed in many countries today, often in even more precarious situations. For instance, by March of 2023, Australia's household debt relative to its GDP exceeded Spain's pre-crisis level, reaching over 116% of the nominal GDP. Spain's peak was 85%. Australian household debt had surged significantly since the 1980s and had become one of the highest among developed nations by 2018. Similar signs are evident elsewhere, driven by generous tax policies for property investors, banks turning a blind eye to violations for profit, migration, speculation, and the belief that beachfront homes should cost 15 times the average annual income. Canada being a notable example. By the end of 2023, Canadian household debt reached 104% of GDP, surpassing Spain's pre-crisis levels. In these countries, stories of builders earning more than their professional counterparts and real estate agents becoming TV stars are common. The rapid increase in Spanish housing prices in the early 2000s now seems modest compared to the soaring property values in these nations over the past 5 years. While it might seem that Spain's crisis ended well, the reality is far from it. Nearly 2 decades later, the country still grapples with the aftermath of that collapse. Spain's response was to follow a path often taken by nations desperate to revive their economies, spending heavily when uncertain about what else to do. Spain allocated more funds relative to its GDP for stimulus measures than any other European country, a move that, while temporarily boosting the economy, left lasting scars from the burst bubble. This ongoing crisis might have remained a topic of endless news coverage, if not for another nation that shifted global attention to its own struggles: Greece. In 2009, Greece's new government announced that its budget deficit was far larger than previously estimated. This revelation shattered confidence in the Greek economy and triggered a wave of concern reminiscent of the Spanish crisis. Yet Greece's problems did not resolve Spain's deeper economic woes. Even as the world's focus shifted away, Spaniards continued to feel the repercussions of the downturn, which left the country grappling with severe financial challenges that persist to this day. While most Western nations experienced the crisis in 2008, Spain was hit particularly hard. Although there was some modest growth over the following years, the country's gross domestic product has yet to recover to its 2007 levels. In the 1990s, wages in Spain were comparable to those in France and Germany, but today the average annual salary is only 29,000 euros, 10% less than before the crisis. Rising costs and inflation have made life more difficult for ordinary Spaniards than it was 2 decades ago. Spain's reliance on external borrowing and debts, especially to bail out banks, forced the country to overhaul nearly all its savings banks, which has made obtaining credit still more challenging. Furthermore, membership in the eurozone, initially seen as a stabilizing step, deprives Spain of the flexibility to manage its currency independently, exacerbating economic difficulties. As a result, many skilled professionals left the country in search of better opportunities abroad, creating a significant shortage of talented workers, an issue that hampers recovery. The era when workers could afford luxury sports cars is now a thing of the past. Unemployment in Spain remains higher than in most European nations. Although signs of growth appear in 2024, many Spaniards are merely taking on temporary jobs without real prospects for the future. For Spain, it may already be too late to fully recover, but other countries still have a chance to learn from its experience. Spain serves as a stark warning. Relying on a single sector or a gamble with the economy can lead to disaster. Its struggles demonstrate that economic recklessness can cause catastrophe anywhere. If such a collapse happened in Spain, it could happen elsewhere too. Reflecting on Spain's story reminds us of the importance of diversification and prudent financial management in safeguarding national stability.